Welcome back to part 2 of long-term investing in single-family rental. In part 1, Greg explained the basics of what it means to invest in single-family rentals over a long-term period. In this video, Greg's going to show you how to research your market using tools on renterswarehouse.com. All right, now back to Greg.
Now you start doing the research. So let me jump over to the Renters Warehouse Investor Marketplace and show you the tools that we've put together. This is not a shameless plug, okay? Although, listen, I'm the sales guy at heart, so every time my mouth is moving, I'm making a shameless plug, but that's not the intent here. The intent is for you to see that I can go in here and let's say I'm interested in Tampa, Florida. I can go in and choose Tampa, Florida. First, I want to check off buy or sell investments. I can check off Tampa, Florida. And in all the markets where Renters Warehouse is, which is, by the way, 40 MSAs, 40 metro markets around the country, we're the biggest third-party property manager. We manage 22,000 houses across the country for some 13 or 14,000 investors. So we've got a pretty broad scope of what's happening in the rental market across the country. And what we've done is loaded up all the same properties that you would find on Zillow on our website, but we've got rental and investment analytics wrapped around them as opposed to sort of the home buyer experience, right? So I'm just going to pick. So here's a little cutie. Look at this. So why does cute matter? Well, if I consider this to be a small business, which I do, and you should also, the product is the house, the customer is the tenant, and I want to have a product that is going to be appealing to my customer. So cute matters. And I can flip through the pictures, obviously, like any website, and just take a look at, okay, it looks like it's updated. It's got some trendiness to it. I like what I see so far. But where is more important than what? Remember? So I'm going to go to the market data tab, and this is where the system starts to show me market fundamentals that matter to sort of give me an idea of the housing demand in the market and how the market performs over the long term. And so the first thing you're seeing here is a 20-year average price chart for the area where this house is. Okay? The green line is the county, Hillsborough County. The black line is the state of Florida, and the blue line is the United States. And what you can see here, forget this little spike up here. That's a little data quirk that I don't usually pay attention to, things like that. It's the trending that matters. So 1996, 2000, the market was stable. All of a sudden we had the housing boom of 03, 04, 05, 06, and people lost their mind, all right? And banks gave out money to people that couldn't qualify for the loans they were being given, so the banks lost their mind. Prices were driven up. The market didn't like that, right? The housing market is like a sleeping bear. You keep poking it, it's going to maul you and then go back to sleep again. So here's the mauling, right? So house prices went out and peaked. Then we had the housing meltdown, the housing free fall. Then the market fought its way back, right? And what I love about this is that both the county and the state and the country all had a similar trajectory. It went up, it crested, it came down, it leveled off, and it kind of ended up, look at this closely. If you establish a trend line on the green line right here, and then all of a sudden it deviates from the trend line, but I'm going to keep my trend line going. Look where it hits, right at the peak, right in between the peak and the trough, almost like a wave, right? There's an equilibrium point in the middle of a wave. So right at the middle of the wave is where that trend line crosses. Then, of course, the market had gone below the trend line, and then it caught back up again. Again, ignore that spike. That's a data point issue that I don't trust. So this data comes in from a lot of different places, and once in a while we see an anomaly. That's an anomaly. Smooth lines, even if they heartbeat like that, are what you want to pay attention to. And my point is the market was doing this for a very, very long time. Then it deviated, and then it broke and came back down again, and then it fought its way back again. And it gives you a sense of confidence that even during a stress test, like the last 20 years, the stress test of what happened 10 years ago, this chart gives you the ability to compare different places around the country and see how those different places performed during that stress test. Then we've got population trends. Obviously, it's important that people want to live in a place, all right? So whether they're moving there or not, and whether the population is growing is a good thing. So this is the county, the green line, and the black line is the state. So you can see that the state is growing in population, but the county is growing in population faster. That's great news. Then you've got migration, people moving in to the area versus moving out. More people coming in, the better. Then you've got unemployment data, all right, tracking with the country. Then you've got job diversity. I really like this chart because this shows the different types of industries that are paying people in an area. And when you see a chart that looks like a pizza pie, where all the slices are, there's not one industry that dominates the market. That's a good thing. No one industry can get caught broadsided and then the market goes down as a result. Okay, so the where in this situation is good. People are moving there, people are staying there. The reasons why they're moving and staying there is the kind of thing you can then go research on your own. Cost of living, all right? No state income tax, quality of life, you're on the waterfront, right? It's a good place to be. So it attracts people. People want to live indoors. It all goes back to that same thing. Now you go to the financials tab, and now you're going to see a lot of numbers. You know, you got your rental numbers here. You've got your taxes, your management costs, your maintenance costs, your insurance costs, your homeowners association. After you subtract from your rent all of those expenses, you have something called the net operating income, which is how much you're making in cash if you paid cash for the property. We'll think in terms of cash right now because it's simpler. This is a year one snapshot. So that's $6,920 that I'm making in cash. When I compare it to the $175 that I paid for the property, that's a 3.95% return on my investment just with the income coming in. I collect my rent, I pay my expenses, I make a 4% return on the $175 that I put in. Not breaking the bank, right? But it's only half the story. Because the house, the way that a house builds wealth is that it generates income and it gets more valuable. It generates cash flow and it increases in equity. So this bottom chart here, these are interactive, right? And the first thing you see is the home price appreciation. That number is from that chart I showed you a moment ago that showed the 20-year average of appreciation for that market. The 20-year average was 4.47% per year. So this shows you over here, if I put $175,000 in, next year it's worth $182 and then $191. And if I'm looking at this thing as being, say, a 20-year retirement program, I can go all the way out to year 20 and see that my $175 is now worth $401,000. So when you sit down and say, okay, I'm 40, I want to retire at 60, I've got 20 years to work with. First of all, that's a lot of time to make some great things happen in real estate. If I plunk down 175 grand right now and just broke even on my expenses, my 175 is going to be a tidy $400,000 in 20 years if this average continued. And by the way, this is the average for the last 20 years, and it even rode through a stress test, right? So you see how this stuff is all tying together? Good. I imagine you all just said yes. Now the other half of this is the cash flow. So I'm making $6,920 in cash on this. There it is, $6,920, rounding error, all right? But I'm going to assume that my rent is going to increase, and it's defaulting to a 2% increase in rent and a 1% increase in expenses. And what that shows me is that I go from 6 to 7 to 7,500. And again, if I was buying this for income, if my financial plan called for income in 20 years when I want to quit my job, this property is going to be paying me $11,395 a year in income if my assumptions are correct. Now, rental rates are going up an average of 3.5% right now. So I'm going to change this 2 to 3 and watch the chart rebuild. Now, in 20 years, my income is $15,000 instead of $13,000, right? And if I said, I don't believe this 4.4, I'm going to make this 3 because I don't want to be too aggressive. That's also going to change this. And then instead of having $400,000, I'm going to have $300,000. So look at that, a jump of 4.5% appreciation down to 3% appreciation. I lost 100 grand in equity. That's why it's so important to pay attention to those demand drivers. If a place is a good place and the reason why people are going there and staying there are likely to remain intact, then I can feel confident that I can get that long-term average of 4.5, and instead of 300 grand, I get my 400 grand. Okay? Please follow me on LinkedIn. I'm Greg Rand with Renters Warehouse. Thanks for watching.